Welcome to The Explainer. Does the stock market ever feel like a high-stakes casino where the house always seems to win? You are definitely not alone. But what if I told you there's a way to actually turn the tables in your favor? Today, we're going to ditch the guesswork and build a powerful, repeatable framework for investing. We're moving beyond the hype and the gut feelings to create a clear, strategic system that'll help you navigate the market with some real confidence.
So here's our game plan for today. We're going to start with the most critical piece of the whole puzzle, the investor's mindset. Seriously, it's the foundation for everything else. Then we'll build out our strategic framework, pillar by pillar. We'll cover how to find true value, how to read the market story to time our entry, how to make our assets actually generate income, and, maybe most importantly, how to master risk. And then we'll tie it all together into a practical system you can start using.
All right, let's dive right in. There's this huge difference between how the average person approaches the stock market and how the pros do it. And honestly, it all boils down to a fundamental shift in how you think. Let's break that down.
For so many people, the entire strategy is, well, it's not really a strategy, is it? It's to buy a stock low and just hope. Really just cross their fingers and hope that it goes high. This is pure speculation. It feels exciting, sure, but it's totally unpredictable and relies on luck, which is exactly why it feels like you're just pulling the lever on a slot machine.
This slide right here really gets to the heart of it. On one side, you've got speculation, which is a total roller coaster of emotions. It's all about the thrill of the chase, driven by hope and fear and greed. It's making short-term bets based on nothing more than a gut feeling. And then, on the other side, you have investing. It's calm, cool, collected. It's a disciplined, long-term process where you replace all that emotion with a system built on solid, verifiable criteria. Think of it this way. You stop being the gambler at the casino, and you become the owner of the casino.
And this is where the real mindset shift happens. You're not just buying a stock ticker. You're buying a piece of a real business, an asset. Like Robert Kiyosaki says, the rich know that money is an illusion, held together by fear and greed. He's basically saying the goal is to break free from that employee mindset of just trading your time for money, and instead adopt an owner's mindset, focused on acquiring assets that generate income for you even while you sleep.
Okay, so that brings us to our very first pillar, which is all about answering that big question, what should I actually buy? This is where we learn to separate the great businesses from all the noise and the hype. And to do that, we're going to borrow from one of the greatest investors of all time.
When it comes to value investing, Warren Buffett is the master, and he has 4 simple, non-negotiable rules. A company has to check all 4 of these boxes, no exceptions. First, he has to understand the business. Think Coca-Cola. It's a simple business model, right? Second, it's got to have long-term prospects. Will people still be drinking Coke in 30 years? Almost certainly. Third, it needs to be managed by leaders who are smart with their money. And finally, the most important rule of all, he has to be able to buy it for a fair price.
That 4th rule is the absolute secret sauce of value investing. It's all about calculating a company's intrinsic value. Think of it like this. The stock market gives you a price every single day, and that price can be swayed by news and emotion. The intrinsic value, though, is what the business is actually worth, based on its real assets, its earnings, and its future potential. Your job as an investor is to figure out that true value.
And this just sums up the entire goal perfectly. Price and value are 2 completely different things. The price is just the sticker price on the car. The value is what you're actually getting under the hood. The whole goal is to find a wonderful business and buy it for less than it's truly worth. That gives you a margin of safety for your investment.
So, you found a great undervalued company. Fantastic, but that's only half the battle. Now we move to our second pillar, timing. This is where we learn to read the market story by looking at its charts. This is what's known as technical analysis.
So the very first step is to just identify the overall direction of the market. You want to be in harmony with the market, not fighting against it. An uptrend where the price is consistently making higher peaks and higher valleys tells us that the buyers are generally in control. It's just like swimming with the current instead of trying to swim against it.
Now, within that big uptrend, we can zoom in and find these key battlegrounds where buyers and sellers are really fighting for control. We call these support and resistance. Support is kind of like a trampoline. It's a price level where buyers tend to jump in and say, yep, this is a bargain, I'm buying. And resistance is like a brick wall, a price level where sellers take over and say, whoa, this is too expensive, I'm selling. These levels give us a fascinating look into the psychology of the market.
So here's the crucial point. Technical analysis is not a crystal ball.
It doesn't predict the future with 100% certainty. Anyone who tells you that is probably trying to sell you something. It's much, much more like a weather forecast. You know, a meteorologist uses data to tell you there's an 80% chance of rain. In the same way, an investor uses chart data to understand the probabilities and the collective mood of the market. It just helps you identify high-probability moments to act.
Okay, let's move to Pillar 3, because this is where it starts to get really interesting. So far, we focused on a stock's price going up. But what if your assets could do more than that? What if they could actually generate an income for you just for owning them? This is the power of cash flow.
I love this concept. Seriously, think about it just like owning a rental property that pays you rent every single month. The value of the house might go up or down, who knows, but as long as you have a tenant, that rent check keeps coming in. We can apply the same exact logic to our stock portfolio.
And this is such an important distinction to get your head around. Capital gains, that's what most people are chasing, but they only happen when you sell. Your net worth goes up and down, but you don't actually have any cash in your hand until you sell the asset. Cash flow, on the other hand, is income you receive for holding the asset. It provides consistent income that you can actually use, totally independent of the stock's day-to-day price swings.
So, how do you actually collect this rent on your stocks? Well, one popular strategy is called a covered call. It sounds a little complicated, but the idea is actually pretty simple. Imagine you own a house, and you're willing to sell it for a price that's higher than what it's worth today. Someone comes along and says, hey, I'll pay you a fee right now for the option to buy your house at that higher price in the future. You get to keep that fee whether they end up buying the house or not. A covered call works the same way. You get paid cash, up front, just for agreeing to sell your stock at a profit.
We've reached the pillar that supports everything else. You can be a genius at finding value and timing your trades, but without this, none of it matters. This is all about answering the single most important question: how do I protect my capital and stay in the game?
This couldn't be more true. The difference between amateurs and professionals isn't that professionals never lose. They do. The difference is that they manage their losses. Risk management is the true foundation of profitable trading. Without it, even a great strategy can eventually blow up.
And this isn't just left to chance or feelings. Professional investors use a specific set of tools on every single trade. They predefine their exit point with a stop loss, they calculate exactly how much to invest with position sizing, they might hedge with options, and they always have an exit strategy before they even enter a trade.
A core principle here is making sure your potential reward is way bigger than your potential risk. For example, you might only take a trade if you stand to make at least $2 for every $1 you're risking. This 2-to-1 ratio means that even if you're only right half the time, you still come out profitable in the long run. You're putting the odds in your favor.
Now, this is going to sound counterintuitive, but this is maybe the most important lesson in all of investing. You have to get good at losing. This doesn't mean you enjoy it, of course not. It means you accept that small losses are just a part of the business. The key is to take those small, manageable losses on the trades that don't work so you protect your capital and you can stay in the game long enough to catch those really big wins. All right, so we've covered the 4 pillars: value, timing, cash flow, and risk management. So now what? How do we combine all these into a single, cohesive, and repeatable process?
This table just lays it all out so perfectly. Each pillar forces you to answer a really critical question. Fundamentals answer what to buy by focusing on the quality of the business. Technicals answer when to buy by analyzing market sentiment. Cash flow strategies answer how it can pay me. And risk management answers how do I protect myself. Together, they create a comprehensive checklist for any potential investment you're looking at.
A very practical way to apply all this is using what's called a top-down approach. You don't start by just randomly looking for stocks. No, you start with the big picture. Is the overall market healthy? Then you drill down. Which sectors, like tech or healthcare, are the strongest right now? Within those sectors, which specific industries are leading the pack? And only then, at the very end, do you look for the best individual companies that fit all your criteria. It's about making sure you're fishing in the most promising ponds.
So, what's the big takeaway from all of this? Real, lasting financial success isn't about chasing get-rich-quick schemes or getting lucky on a meme stock. It's about patiently and deliberately building a solid foundation, one pillar at a time. The alternative is what I call the Leaning Tower of Suburbia, a financial life built on a shaky foundation of debt and hope. So I'll leave you with this question to think about. Are you building a skyscraper or are you building a leaning tower?